I've been evaluating debt fund operators for the last couple of months, putting them through what I consider to be a pretty rigorous process, including background checks, financial audits, loan level analysis, legal and compliance structure review, and a review of financials, and actually more than that. And the most surprising thing that I've found so far isn't what I expected when I started this process. The operators that look best on paper they're not always the ones that I'd actually want to invest my money with. And it's not because they're dishonest, because most of them are not. It's because there's a difference between an operator who built a good-looking fund and an operator who built a solid management company and a fund or funds that will actually protect your capital when something goes wrong. So coming up, I'm going to walk you through the specific things that I now look for when evaluating all the funds that I look at. Things that most investors never really think to ask about. And I'm going to show you what each one looks like using real examples from funds that I've actually reviewed. So none of these funds are going to be named, but everything that I'm about to share in this video is based upon real documentation that I have personally gone through. So before we dive into the video, let me give you my standard disclaimer. I'm not a financial advisor, and this video was created for education and entertainment purposes only. So with that out of the way, let's dive into the good stuff. So if you've been watching this channel, you already know that I'm a big believer in real estate debt funds. The structure is very simple. The returns are great. And as a lender, you're always ahead of the equity investors in the capital stack, which means that you get paid before the equity investors ever see a dime. And I like that comfort. But there's one thing that matters more than any of that, more than the returns, more than the structure, more than the asset class itself. It's the person or the team that is actually running the fund on a day-to-day basis. So in public markets, you buy an index fund and the market does its thing. Nobody at Vanguard is sitting at a desk on a Tuesday afternoon deciding whether to lend $400,000 to a guy who wants to flip a house in Kansas. But in a debt fund, that's exactly what's happening. Somebody is making that decision. And the quality of their judgment and their processes and their experience and their discipline, well, that's your investment. You can have the best in class in the world, but if the person managing it makes bad decisions, well, then your capital is at risk and you won't know it until it's too late. So the question becomes, how do you figure out if the person or the team running the fund is actually good at what they do? Not from the marketing, not necessarily from the pitch deck, but from what it is that they've actually built. And that's what I want to break down for you in more detail. So let's get on to that. So before I get into the big three things I look for in an operator, I want to give you something that you can use right away. A filter that you can apply before you even get to the due diligence stage. Because most people start by reading the marketing materials. And that makes sense because it's your first look at the fund. But the marketing materials are designed to make everything look as good as possible. That's obviously their job. Your job is to know what to question and when to go deeper. So here's what I mean. One fund I evaluated marketed an average loan to value of 66 to 68% with a stated maximum of 75. Those are conservative numbers, exactly what you'd want to see in a debt fund. Plenty of cushion between the loan amount and the property value. But when I pulled the actual loan tape, the real data showing every loan in the portfolio, the average LTV was closer to 79%. And some individual loans, well, they were over 100%, meaning the borrower owed more than the property was worth. That's a big red flag. And that's also a completely different risk profile than what the marketing material suggested. Same fund, marketing returns of 24 to 26% described as their conservative target. The audited financial statements showed an annualized return of just 10%. Now, there might be a reasonable explanation for that gap. It could be a ramp up of their warehouse line of credit. It could be new revenue lines coming in. It could be loan underperformance. There's any number of things, but the gap is there. And if you didn't check, well, then you'd never know. So here's the takeaway. Whenever you see a number in a pitch deck, returns, LTV ratios, default rates, you need to ask yourself a question. Where can I verify this information independently? If the answer is you can't, well, that's not automatically a deal breaker, but it is a huge red flag. And it means you need to go deeper before you go ahead and write that check. Now let's get into the three things that I look for that separate a good operator from a really good operator. And I want to start with one that matters most. And it's what happens when a loan goes bad. So every debt fund is going to have loans that default. It's the business. A borrower misses payments, a project runs over budget, a property doesn't sell when it was supposed to. All of that stuff happens. And a well-run fund is built to handle all of those scenarios. So the question is not whether an operator has the defaults, it's the question is, what did they build to deal with those defaults? So I evaluated two funds recently. I'm going to call them Fund A and Fund B. Fund A had a written default process. It laid out what was supposed to happen when a borrower stopped paying. Notices, timelines, legal escalation. It looked professional on paper, but when I looked at the actual portfolio, 2 out of the first 6 loans in the fund were in default. That's a 33% default rate on their original deployments. The single largest loan in the fund, well, that was 36% of the entire portfolio, and it was 120 days past due. And management acknowledged in their own documentation that they had moved too slowly on enforcement. So the process existed, but it hadn't been tested. And when it was tested, the results, well, they weren't very good. Fund B also had a default process, but theirs had specific timelines that were being followed. Default notice at 15 days, formal default letter at 30, legal escalation on day 40. They had just shy of a 12% delinquency rate, which is on the higher end than you'd want to see. But for every troubled loan, they could walk me through exactly what was happening with it, not in theory, but in actual practice. This borrower is on a payment plan. This one is in foreclosure. This one we expect to resolve by the third quarter. So they'd been through it. The process wasn't a document they wrote and then filed away somewhere. It was actually something that they used every single day, and that's the difference. Fund A's process was a document. Fund B's process was a muscle that they were flexing on a regular basis. So if you've been running a business for 20 years, you already know this instinctively. How someone handles a crisis tells you more about them than how they handle a good quarter. Exact same principle applies here. So here's the question I'd ask any fund manager that you're evaluating. Say this to them. Walk me through your last loan default from start to finish. Now, if they can give you a clear, specific step-by-step answer of what they did, what the timeline looked like, and what the outcome was, well, that's obviously a good sign. But if they get vague or they kind of give you a textbook answer instead of a real answer, that tells you something pretty darn important that I suggest you pay close attention to. The second thing I look for is an alignment of interest, and this goes deeper than most investors might first think. The most important question I ask every fund manager I evaluate is this: how much of your own money is in this fund? Not your management company's money, but your personal money, the money that came from your bank account. Because if the person asking me to invest won't invest alongside me on the same terms, well, I want to understand why that is. So one fund I reviewed had no clear disclosure on how much personal capital the principals had committed. I asked directly. And as of my last conversation, I still didn't have a dollar figure. So that doesn't mean that they're bad people, of course, but it does mean that I can't confirm that their financial interests are aligned with mine. And I don't really like that very much. So let's compare that to an operator where the principals have personal capital committed to the fund, and it's clearly disclosed in the offering documents. That's a fundamentally different conversation because now when they make a lending decision, their money is out on the line in addition to mine. The third thing I look for is transparency. And I don't mean what they say on a webinar. Every fund manager will tell you that they're transparent. It's going to be on every one of their pitch decks. It's going to be in every presentation. But transparency is easy when returns are good and everything is performing well. Hey, we're doing great. Look at us. But the real test is what they do when things aren't going so well. Do they call you, or do you find out 6 months later buried in a footnote someplace? So here's something I found during one of my recent evaluations that really stuck with me. One fund marketed itself as having 0 losses across 100 loans. 0 losses. That's a pretty bold claim. And technically it was true. They'd never realized a final loss on a completed loan. But when I pulled the loan tape, the actual data on every loan in the portfolio, I found 7 loans in default. 4 of them were in active foreclosure, and 2 of those loans had been delinquent for over 700 days. That's almost 2 years without the borrower paying any interest. There were millions in accrued unpaid interest sitting on the books. So 0 losses and 0 problems, well, guess what? That's not the same thing. And a fund that presents one while sitting on the other is telling you something very important about how they communicate with investors. Now contrast that with a different fund that I evaluated. This operator sent detailed quarterly letters that included specific updates on every troubled loan in the portfolio, not just the ones that were performing well. They also opened their entire data room to an independent third party for follow-up diligence. Nobody asked them to do that. They did it because it's how they operate. That's what real transparency looks like. It's not a claim on a marketing page or a brochure. Instead, it's a behavior that management has baked in. So here's what all of this comes down to. A great operator builds their entire operation around the assumption that things are going to go wrong. They build the workout process before they need it. They put their own money into the fund because they're confident in what happens on the downside, not just the upside. And they communicate honestly, even when the news isn't really that great, because they already planned for that conversation. A good operator hopes things go right. A great operator assumes that they won't, and they build their processes around that. That's the difference. And once you start looking for it, it becomes much easier to spot. So here's some additional insight for you. One of the funds that I evaluated, I genuinely wanted it to work. The market they were operating in made a lot of sense to me, and the people running it, well, they seemed very credible and I liked them. And the returns they were targeting were exactly in the bracket that I was looking for. But when I put them through the process that I've described to you in this video, when I pulled the loan tape, when I looked at the default history, when I checked the management company's financials, and I read the legal documents line by line, the numbers didn't hold up. The concentration risk was too high, the government's protections weren't there, and the early track record raised questions that I couldn't get comfortable with. So I walked away and I didn't invest. And that's the whole point of doing this work. You have to be willing to act on what you find, even when you don't like the answer, because the most expensive mistake you can make in this space is talking yourself into a deal that your own due diligence told you to pass on. So I'm not going to stand here and pretend that I have evaluated 200 funds and I've got this whole thing figured out. I haven't. I've looked at a few dozen operators so far. I've been investing in this space for a number of years. And what I've shared with you today is what I've actually found, including the deals that I decided not to do. I'm building this process in real time, and I'm going to keep sharing what I find as I go. The ones that pass, the ones that don't. Because if you're the type of person who's thinking about putting serious capital into these types of investments, I think that you deserve to see what the evaluation process that I've created actually looks like. Not the polished version, but the real one. And that's what my channel is for, so I hope that you stick around. Now, speaking of sticking around, if this is your first time watching a video, welcome and thank you for watching this far. I highly encourage that you visit my website, investwithtrent.com, because on that website there are additional resources for you. And if you'd like to enter your email address and join the accredited investor email list, then there's going to be a whole sequence of educational emails that you'll receive that'll help you to understand investing in this space even better. And then finally, if you have questions or comments about this video, please do leave those in the comments down below. And if you enjoyed the video, go ahead and smash the like button, as that'll tell YouTube it should share it with other people. My name is Trent. Thanks for watching. I'll see you soon. Take care. Bye-bye.